Thanks for joining, everyone. I am blown away by the attendance we're getting uh, for a webinar with the exciting title of Positioning Vacation Rentals as a Tax-Advantaged Asset Class. Um, or as many folks are learning about this today, what is this STR tax loophole, right? And so our goal here today is to really empower all of you to be more knowledgeable on this. We have a great team that's going to do this. We have our representative real estate broker, Jason Evanchek, and our keynote, our expert in this space, Jason Watson with WCG CPAs and Advisors. My name is CJ Willey. I'm Senior Director and Corporate Counsel here at Evolve. I'm coming to you from our HQ in downtown Denver, and I'm responsible for the wonderful world of STR regulations, and all of our state licensing, our real estate licensing, and our government affairs work. And I'm also coming to you today as an Evolve owner and someone who has personal experience with the STR tax loophole going back to roughly 5 years ago, when my wife and I first learned of this. And I thought it's interesting to give you a little bit of our story just to kind of see things from, a potential client's perspective and really contrast where we were at, 4 or 5 years ago. It doesn't sound like that long ago, maybe before the dawn of AI and all these services that serve us with great information at our fingertips. Um, but where my wife and I were at when we first learned about the STR tax loophole, and we'll get into more of the details, I assure you. Jason Watson will speak to that. But I remember we first learned about it from a Facebook group called Semi-Retired MD. And my wife is a doctor, and we had done a little bit of real estate investing, and so we were in this group, and I kept seeing this STR tax loophole come up. I assure you, we're not even close to being semi-retired because we have 4 kids. But yet we were in this group, and we were learning about it. And so I started to research, and there were just, some blog posts, but nothing comprehensive. And so we shot it to our original CPA, and he was not knowledgeable. I remember he probably didn't put much thought into it. He said, "This looks like it's for someone who's running a bed and breakfast." And I recall he said, "You probably have to be putting mints on the pillows to take advantage of this." And so that might have been a stopping point for us. But luckily, I'm a lawyer and a stubborn one. And so I really dove into the regs, and I educated myself. I learned more about it, and I said, I think that these rules could work. Um, and presented that to my wife. She wasn't quite convinced. If you know anything about marital dynamics, she wanted a little bit more than her husband, lawyer, advocate, diving into the IRS regs. And so we started messaging some people in that group, and they were real people. They confirmed they had great results with this strategy, and one was even an Evolve owner. And so that got us to move forward, and we started looking in the mountains. Our real estate agent was not knowledgeable, but she was more open-minded, and she did ask around. And she eventually found some folks who had taken advantage of this tax strategy and connected us to a cost segregation study. And I guess the third leg in this table was that we already had. I had just started working at Evolve. We knew we were going to use Evolve, um, and that was a good thing because looking at the internet messaging boards at the time, they had broad statements like you can't use a property manager, which is another kind of statement we're going to debunk today. So, um, long story short, that was our experience. We ended up having a fantastic result, and it really opened our eyes to how powerful this tax strategy is. And if you compare our experience then to today, ChatGPT and Gemini and any AI engine you want to use will direct you and even prepare materials for you. And if you Google it or search on social media, first of all, you will get inundated with ads for services that will guide you through the process, some for a very high fee. But it's become much more mainstream. And so the what we're empowering folks today is to really think from the client's perspective. You know, what if you had a knowledgeable real estate professional guiding you every step of the way? That they had this perfect management solution for you, Evolve, which fits into this tax strategy. They can connect you with an expert CPA like a Jason Watson, um, and connect you with a cost segregation firm. We'll get into that. Don't be intimidated by that term. And then you can achieve a great result, like we had with Evolve. If anyone wants to bring it full circle and see our place up in Steamboat Springs, unfortunately for this winter, despite the lack of snow, we're pretty much fully booked, because Evolve is so good at driving bookings. And so, long story short, there, Emmy's upset because I went over time, but I just thought I wanted to kind of lay the groundwork for you in terms of um, this STR tax strategy. And if anyone hasn't checked out the blog post from Evolve, maybe we'll put that in the chat as well. And it's a great resource because it kind of draws it all together and talks about why Evolve is a great solution. So without further ado, we're going to introduce you to Jason Evanchek, who is Evolve's representative broker for state licensing purposes in many states. I'll let him go into that, and then we'll get right into our keynote. Thanks so much. And
Hey, yeah, go ahead,
ground
CJ.
rules, any questions that people have, let's try and use the chat. Um, and we will have a robust time for Q&A a little bit later in this session. Go ahead, Jason E.
Perfect. CJW. Yep, you got two Jasons and a CJ here. Hey, good morning, everybody. Thank you so much for joining this webinar. This is fantastic. As CJ had mentioned, I do a lot of work as a compliance broker in a number of states: Nevada, Colorado, New Mexico, South Carolina, Georgia, Tennessee, just to name a couple. But I want to come to you today as a fellow agent and broker, if you will. Throughout my career, I've always had a focus on adding value to clients beyond the transaction. And one of the most common questions I get right now, I'm sure you're getting it: can this property be used as a short-term rental? And how do I do it the right way? So you're going to learn today about some of the STR tax implications and strategies that your folks can use. But let me just bring it home to you real quickly so that you have a level set for the rest of the time. Short-term rental, these conversations are going on right now, right? Whether we initiate them or not. So if we don't guide that conversation with our clients, somebody else is going to. So we need to keep our clients' best interests and our licensing in mind. And there's a real opportunity that exists here to keeping us in that expert role, if you will, reducing risk for clients and strengthening long-term trust. The key point here is us as agents and real estate professionals, we don't necessarily need to become an on-the-ground property manager. What we need is a professional operating partner, a la Evolve, that we can confidently bring into the conversation. And that is where Evolve comes in, because as Evolve specializes in those operations from onboarding and marketing, pricing, guest communication, support, I have found this being part of a network for many years. This separates Evolve from anybody else out there in the industry. When clients want to understand how this model works, I encourage us real estate professionals, go to evolve.com. There's a clear, transparent overview. Let's go here. From my perspective, compliance matters, right? And as a real estate professional, you can ethically and compliantly connect clients to the best-in-class STR platform with Evolve. This is going to allow you to remain focused on building relationships, get your transactions done, be that trusted advisor. Let Evolve handle what they're excellent at: onboarding, marketing, guest services, ongoing operations. And it's simple. This is what blows me away. The process: you identify the opportunity, make the introduction, let Evolve take it from there. There's no burden on you, no late night calls, management headaches, all that stuff. So again, let me close out. We're all real estate professionals tied in at some point: agents, brokers. There's a mortgage guy on here too, probably a couple. That's fantastic. All of this comes really at no cost, but all benefit. Your client gets a short-term rental solution. You add measurable value to the relationship and protect your license with future-proofing business. And so I ask myself, and why I am just thrilled and blessed to be a part of the team, is why wouldn't you want Evolve for your clients. So with that, I'm going to pass it back to Emmy. Thank y'all for being on the call.
Thanks, Jason. And I'll pass it over to Jason Watson, since we have two Jasons today, to introduce yourself, and then that will lead into your presentation.
Good morning. Thanks, Emmy and Jason. Thanks for that. CJ, thanks for the invite. Good morning, everybody. My name is Jason Watson. I'm one of the partners at WCG CPAs and Advisors. My wife and I began this firm 18 years ago, and we've really evolved into being a small business specialist. And we look at STRs like a small business. You can go to the next slide deck here. Thanks. And you can go one more. Thanks. So this is this is who we are, but we evolved. I guess a good choice of words. We evolved into small business specialists and real estate experts as well, because we feel like those are very married segments of business. We've gone even further, and we've identified 5 individuals at our firm who have a flair for rentals and for real estate, and we've created a rental expert pod. We have all of our micro teams are called pods, and so we have rep for short, and they will handle all of our rental activities. And we did this intentionally because short-term rentals are nuanced, very nuanced. If you have a long-term and you mid-year convert it to a short-term, what happens? If you have a short-term for ski season and you convert it to to long-term, what happens? All these different nuances that getting 40, 50 tax professionals all rowing in the same direction is difficult. So we've identified 5 individuals, and we said, hey, you're going to be experts. And the reason why is 38% of our tax returns are going to have rentals on them, and half of those will be short-term rentals. So it's a lot of volume, and we want to concentrate that expertise. You can go to the next one. Thank you. Real quick, there's really three marriages, or 3 things we have to put together into a marriage. We have to have a short-term rental. We have to have a cost segregation study, and then we use that to apply bonus depreciation. The rule for short-term rentals is very simple. The average guest stay has to be 7 days or less. If you have a guest stay that's over 7 days, that's fine, as long as the average guest stay is 7 days or less. The actual rule doesn't talk about guest stays. It talks about average customer use. So it could be bicycles, kayaks, it doesn't matter. But in the context of STRs, we say average guest days. So you have to have 7 days or less average guest day, and you also have to participate into the activity as the owner. And there's 3 large rules: 500 hours a year, 100 hours, and no one did more than you. That's usually the one that everyone uses. And then substantially all hours. And we see the substantially all hours often when you're putting an STR online, let's say in Q4. So like in October or November, something like that. What's the net of it? We said, when you're talking to your clients, people who are looking to invest, your investors, your buyers, we can safely say about 7% of the purchase price will basically be your cash in pocket. You spend $1 million, let's say, on something, $70,000 will come back to you in cash, and we'll tell you how that works. This is assuming about, and this number varies, but we're going to use 70% for the building, 30% for land, and that's not a rule of thumb. That's not a safe harbor. You actually have to use the county assessor's ratio, but we're going to look at that for our 7% math. So 70% is the building. We're going to use 25%, let's say, as an average cost segregation study, which identifies the property in the building that's eligible for accelerated depreciation. We're going to marry that with 100% bonus depreciation, which allows you to instantly depreciate and deduct all those things that are identified in that cost seg study, and then times that by a 35% tax bracket. You can go to the next one, Emmy, thanks. The 7% is a nice number because you can almost look at it like the IRS is funding a third of my down payment, right? If you're using a 20% down payment. The big thing is investors think that, hey, I don't want to have to scrub toilets, right, to qualify. I don't want to have to really be boots on ground. Can I use a company like Evolve to manage the property, yet I can still do the participation hours that I need? And the answer is yes, 100%. We have materials on our website in my book that I wrote that specifically addresses how do I achieve material participation while using a property manager. And it's a lot easier than you think. So here's the 30-second script that we wrote out. Basically, I just tell folks, hey, 100 hours a year is just 2 hours a week. And if you're going to grab a $70,000 cash in pocket for buying $1 million short-term rental, that's basically a $700 an hour billing rate, which is not too bad. You can go to the next one. Thanks, Emmy. So the ask that I was asked, if you will, to present to you is think about some of the past deals that you've done. Are those investors able to go back in time and take advantage of something that maybe they didn't do in 24? And the answer is yes. You can buy a rental in 24 and not have the right data from your CPA, and then realize today that you could have done a lot of things to improve your tax footprint. And the answer is a look back cost segregation study. And we can talk about that during Q&A. And you can go to the next one if you want. That's just the resources that we have available out there. WCGinc.com/STR goes to our blog post that I've written, and then WCGinc.com/book goes to one of the 2 books that I've written was on rentals. And there's a whole chapter in there on short-term rentals, a whole chapter on cost segregation. In addition to that look back cost seg study, we talk about what hours you have to invest into the property on an annual basis and many other things. So those are some resources that you can look at yourself and also pass on to your teachers. And I was asked to keep this short, so I'm whipping through this intentionally so we can get to, I think, is going to be the fun stuff, which is Q&A.
Great. Thanks so much, Jason. We have some pre-written questions that I am going to ask out, and then after that, we will open that up so that we can get some questions from you all in the audience.
And for the audience, Emmy has not given me these, so these are just going to be raw answers to her wind-up. So
keeping it a surprise. And
yes.
Patrick, I see your comment. Will be happy to share the slide deck after this. So first question, Jason, which is coming at you. With the 100% bonus depreciation restored for 2026, is there a specific sweet spot for property value or type that yields the best tax return? So, for example, like a 500,000 beach condo versus $1 million mountain home.
Yeah, it's a good question. You're going to be looking at land value versus the building value. And with the Nielsen tax court case, the IRS is strongly leaning towards just basically using the county assessor's website. And I think, CJ, you're going to introduce your cost segregation partner as well, but they have a API tool that will tunnel into the county assessor's website to extract that land versus building value and use that. So if you look at $1 million house in Malibu versus $1 million house in Topeka, Kansas, I think we can all safely assume that land values will be different, right? Usually in STR rich environments, whether it's 30A, Gatlinburg, Tennessee, something in Southern California along the Eastern Seaboard, although in mountain communities, there's lots of opportunity for STRs, right? But a lot of that stuff is going to have a high land value as well. So you have to be careful. So what's the sweet spot? It's hard to identify one. Just understand that, you know, $2 million assets aren't going to necessarily yield the same result simply based on the building versus land value.
Great. Thanks, Jason. Next, want to lean a little bit more into the evolve advantage. So to hit the 100-hour requirement, an owner must participate more than anyone else. With that said, why is Evolve's distributed team model an ideal solution for ensuring that no single person at our company outworks the owner's log? CJ, I'm going to throw that one at you.
Yeah, sure. Um, you you can imagine that you may run into a problem if you were using kind of an old school um, in-market full service property manager that you hand the keys off to, and then they're doing everything for you. Evolve is not that, right? Evolve is a suite of services where we do all of the tough stuff on the tech side, and we let owners coordinate the on the ground operations. I will say, from my experience, it does start to work like clockwork. And if you have a team of cleaning partners, that is a wonderful solution, right? And so I can speak to our situation. We have our cleaning partner is the guest contact. That's one person in the office. It's a different number of cleaners that would come and actually do the turnover cleanings. Um, but no one at Evolve specifically is going to outpace you in terms of how much time you do spend or can spend on the property. Meaning for the owner, anything that you do on the repairs, maintenance, and improvements side, right? Any renovations you do. Um, I'm not the most handy. For me, for example, just installing a Nest thermostat. Um, for me involved, buying it here on the Front Range and driving it all the way to Steamboat. That's what that trip was for. So all of that time counts. And then actually installing it, doing inspections, on-site visits, to check in on your property, vendor coordination and supervision, for example, if you have repairs, right? That those are times when you can really rack up those hours. You can also, Evolve doesn't prevent you from participating in some of the guest communications. If you want to send a note to the guest and say, I'm the owner of this property. If you have any questions, feel free to reach out to me as well. We don't prevent someone from doing that, and that's a great way if you do that on a per stay basis to rack up more hours as well. But I will say the sweet spot really is in any sort of improvements that you're making to the property. So, um, the repairs, maintenance, improvements, anything goes wrong, renovations, uh, interior design, um, and then permitting as well was my world, and renewals and those kinds of things and dealing with local governments, that all counts as well. And Hyatt, I see you're asking, what does the tracking of the time look like? Great question. For us, it's a Google sheet, and every time I'm making a trip to the property for the purpose of any sort of repair, improvement, et cetera, I'm tracking that time. And some of the AI tools are getting really good at helping you with this as well. You can plug in all your time and say, put it into a spreadsheet for me, and it'll do that instantly as well. So it's a great way to track on an ongoing basis. And I'll say it's pretty easy to hit this 100 hours. Jason had presented it as a couple of hours. per week. You can think of it as, 10 to 12 hours per month. But we all know if you're doing anything structural at the property, you can really rack up the hours. Furnishings, installing in an IKEA desk takes me longer than most. Um, Reading all that Swedish. So,
Go ahead.
all of those
Yeah,
things count.
I'll go ahead and add to that, CJ, and sort of kind of cut you off there. But it's not just hands-on stuff. When PMs call and say, "Hey, I need you to approve this estimate," or "I need you to do this," that on the comfort of your couch or your home office, that time counts. Reviewing maintenance logs, reviewing work orders, reviewing financials, not as much. That's considered an investor activity. It doesn't count. But doing your own books, balancing your own checkbook, all that stuff counts. So it's not necessarily boots on ground time. That time certainly does count, but there's also some things you can do from the comforts of your home as well.
Yeah, and time in the Evolve owner account for certain activities, like setting custom min rates for certain times. Sometimes Evolve owners like to put a certain custom min rate in for a week that they might want to use the property, but they're happy to get a really high rate. Those types of day by day adjustments, you can also count all of that in material participation.
100%. And even, competitive analysis, competitive review of what your neighbors are doing as well, because STRs are a business. And that's probably something that I like to stress a lot to people is, first of all, the investment has to be a good investment, a wealth building investment. And secondarily, we can make it a tax efficient one. But it's also a real business. And as you guys probably all know, that people are really choosy about which rental they're going to rent for the weekend. What's the coffee maker, all that stuff. So when you look at running a business and tracking your competition and always trying to do a better job tomorrow than you did today from the administration of your STR, that time counts. It's running a business. So just keep that in mind. And somebody mentioned spreadsheets as well. We see a lot of spreadsheets for time logs, and that's great. There are apps available out there for your phone. The reason why an app is typically preferred is that it's in real time. Oftentimes you forget to put entries into a spreadsheet when you're like, oh, I got to race home and type this up. If you can just do it right there on your phone. A lot of these apps will also track your mileage, your time spent driving. You can be at Home Depot and actually scan the receipt, because it's not just enough to have a time log. If you put a time log in there saying, hey, I installed a Nest thermostat, the IRS agent or whoever's reviewing this could also say, well, cool, show me the purchase of that Nest thermostat. So if you go to Home Depot, you buy your Nest or wherever you buy your Nest from, and you can corroborate your time entry with the purchase of what you needed to do on the rental, that goes a long way. So some of these apps can tie both the tracking of mileage and the tracking of time with the scanned receipt and corroborate all that together.
That's great. And I'm going to pivot a little bit and take a question from the chat. Is this write-off only available in the first year? What about future years?
Yeah, it's a great question, and that is something that needs to be aware. This is a one-shot injection into your arm, if you will. So when you put a rental online, and it's what we call in service, and that's ready and available for rent. You don't actually have to have a tenant or a guest to be considered in service. In service is just ready and available for rent. And you do a cost segregation study, which is where these companies will go out there and you typically virtually identify components of the structure that are eligible for 5, 7, and 15-year depreciation schedules. Otherwise, your short term is not limited, it's extended to 39 years of depreciation. So we want to accelerate that depreciation down to 5, 7, and 15-year buckets. A cost segregation study does that. Next, because those assets have a 20-year life or less, they're eligible for bonus depreciation. So we take the 5, 7, and 15-year assets and we instantly depreciate them in the first year. So what a cost segregation study is doing is identifying things that are available for a shorter life, and then the tax law of bonus depreciation says, hey, let's just grab it all now. So what you're doing is you're taking future depreciation that is available to you and taking it all today. If I take one rental and just do a straight 39 years, I do another rental and do cost seg and bonus and all that stuff. At the end of both those lives, if you will, 39 years, they'll have identical depreciation. So you do get a big chunk in the first year. Year 2 through 39 are actually less than had you not done cost segregation. So there's a little bit of a trade-off because all you're doing is grabbing that future depreciation today. So cost segregation doesn't identify magical deductions. It just identifies the ones that you can take now sooner. So this is a cash flow ROI play. Nothing short of that, or more than that, I should say. Does that answer the question, Emmy?
Yeah. Feel free to follow up in the chat too if there's follow-up questions there. Thanks, Jason.
Yeah, well, yeah, one of them was like depreciation recapture. Do we want to talk about that just for a hot minute? That's always the concern, right? When people say, well, I'm going to have to pay all that depreciation back when I go to sell it. Yes and no. If you do a 1031 like-kind exchange, and then it's distant cousin to 721 exchange, that's when you kind of exchange into a syndicate. Those recapture and gains are deferred. And that's through a 1031 like-kind or a 721 exchange. 721 is the section code, and so is 1031. But yeah, depreciation recapture can be a problem. And getting nuanced a little bit, the property that's identified for accelerated depreciation will recapture up to your ordinary tax rate. The depreciation that you took on the remaining part of the building, the main building, that is recaptured up to 25% or your marginal tax rate. Not that you need to necessarily be telling this to your, to your clients, but there are some nuances with recapture with how, let's say, painful it might be, depending on what's being sold. And hopefully that answers the question. If not, we can do more follow-ups on that.
Thanks, Jason. And another one for you, Rob read my mind a little bit here. Can I apply this strategy to a property I already own, or does this only apply to new acquisitions?
Yeah, so that's the cost seg look back, and I will, give me a second. I'm going to put that into the chat as well. So you buy a rental in 2024, you make it a short-term rental with Evolve, and everything's going great. And you file your tax return, and you're not really aware of some of these rules and all that stuff. And later you find out that, oh man, I could have taken all this bonus depreciation and all this stuff. 2024 is probably not the best example because bonus depreciation was 60% in that year, but you can do a look back, and I'll even do it better than this. So let's say in 2021, you put a short-term rental online, and today for the first time, you're hearing about bonus depreciation and short-term rental loophole and all these things. We can take your 2025 tax return. We can do a cost segregation study back to 21, because it's always going to go to the service date of the asset. And we can identify all that 5 and 7 and 15-year assets. We can accelerate that depreciation as if you took it in the original year of 2021 and and plop that on your 25 tax return. So there is some arbitrage available, because if your income tax rate's way higher in 25 than it was in 21, this actually works in your favor, because you're going to get more bang for your cost seg buck, if you will. But yeah, it's a Form 3115, which is a change in accounting method, which is what the IRS, in a very nerdy way, says when you want to take depreciation that you didn't take in the past. It's technically a change in accounting method. And then we do what's called a 481A adjustment. We look at the depreciation you already took, what you should have taken. That difference then becomes a deduction in the current tax year. So hopefully I didn't geek out too much on that one.
No, thanks for answering. That's a great question, and super interesting to hear about. Another question that I'm seeing in the chat is there limitations on making a short-term rental my personal home after doing the cost seg?
Oh, no, that's actually, that's some more arbitrage for you. A lot of folks are like, look, we want a second home one day, not today. We have 4 kids like CJ or something, where life's a little busy, but we're thinking ahead and we want to have a second home somewhere. Okay, fine. So let's go ahead and buy it. Let's go ahead and do it as a short-term rental. And we'll just keep doing all that. We'll take our tax advantages and do all that stuff. And then 15 years later, 20 years later, and there's no time limit on this, I'm just picking out numbers. You kick everybody out. You say, hey, Evolve, it's been a nice run, but my wife and I, my husband and I, my spouse and I are gonna use it as a second home. That is 100% fine. That's 100% fine under bonus depreciation rules. Could you use Section 179 rules to depreciate the 5, 7, and 15-year assets? There are clawback provisions should that property be taken offline from being a rental. So let's talk about a very extreme example. You buy a rental in 2025, you make it a short-term rental, and you take your big deduction. January 1 of 26, you stop renting it out and make it your second home. That is technically fine on its face. Now you might have to demonstrate, some other things if an agent comes calling, but that is fine on its face. So hopefully that answers the question. But yeah, it's a strong play to help defer cost of that second home, get a tax advantage, and then 15, 20 years, you have a nice second home, probably mostly paid for, all that.
That's great. Is the total you can save with the loophole determined by your income of your property, of your primary career, aka how much income tax that you have paid?
Yeah, it's a great question. And that is because like I said before, this is cost segregation is a cash play, meaning you're spending money today to buy future tax deductions. And I wrote an article on this too. Here it is. And I'll put that in the chat. So we have people, for whatever reason, they're in the 12% marginal tax rate. And they're like, hey, I want to do max cost segregation and do all this stuff. And we're like, hold off. How is income next year going to look? Because you're really only garnering a 12% benefit given your marginal tax rate. And if they say, oh, my income's gonna be way higher, spouse is going back to work after family leave or whatever, or a big bonus, big RSU bonus is coming in or whatever, I'm like, well, then let's delay our cost seg to a year that makes sense. Mm-hmm. And then another thing, if you have an investor who's got 5, 6 rentals and they're just waking up to the first time in hearing cost segregation and bonus, sometimes we'll say, hey, let's not cost seg all your rentals in the first year or in the same year. Let's spread this out. Because you don't want to go from 35% tax rate to 24 to 12 to 10 to even creating a loss for yourself, because that last dollar in reverse is not really giving you that much advantage from a cost segregation perspective. We can geek out a little bit more. There's 5, 7, and 15-year assets, right, that are eligible for bonus depreciation. We don't have to take them all. We can opt out a 5-year. We can keep the 7 and 15, and sometimes we'll do that. We'll say, hey, let's let the 5-year asset continue to depreciate over 5 years. That'll give you some future deduction. Let's take the 7 and 15 right now today to give you some instant cash. So you kind of hedge your bets a little bit with that as well. So we do want to look at that to make sure that you have some good bang for your cost seg buck.
Nice. Thanks, Jason. Another one from the chat that is pretty niche. What about a property that has joint ownership? Portion of the property is long-term rental, portion of it is short-term rental, portion of the property that is primary residence.
Yeah. And common situation, it's your situation, LOL, but it's a common situation as well. Great example, right? You have a primary home, you rent out the basement. You have a primary home with the basement rented out and an ADU, right? And you have all this stuff going on. As long as we can identify a separate dwelling unit, and that is typically cooking facilities, sleeping facilities, and a bathroom facilities. And in boating terms, a galley, a head, and berthing quarters, right? So as long as we have those 3, we can identify that as a separate dwelling unit, and it can be a different activity. It is very, very common to have the main floor be your primary, the basement's long-term, the ADU that you built is short-term. And that is all fine. That is all fine. We're going to have 3 rental or 2 rentals in that situation. The STR is going to just do its thing with cost segregation and all the benefits that gets you. The long term is going to continue to do its thing, and the primary residence is just. When we look at cost segregation, when the building is shared, like the basement with a separate entrance and all that, we usually use a square footage ratio, because they're gonna do a cost segregation on the whole building, and then we're going to parse that out, what's eligible for bonus depreciation based on square footage, let's say, of the basement in my example. So a dwelling unit is going to be separate kitchen, separate bathroom and bedroom, right? All 3 of those. Now we start getting nuanced, like, hey, if I give the guy a hot plate and a mini fridge, is that considered a kitchen? Probably. You have to be a little bit careful how you do this. What really buttresses the separate dwelling unit, this separate dwelling unit argument, is a separate door, certainly a separate address, and sometimes it's enough just to say A and B unit, right? The A unit is mine, the B unit is my renter's. Separate driveway, all that. Now, if you can actually record a separate address with the county, then that's even more golden. But yeah, hopefully that answers the question for you. I forget who it was who posted that, but whoever Google Pixel 9 is, hopefully that answers your question.
Yeah, the amount of times it evolved that we've had the conversation of whether a hot plate is a kitchenette or not, or whatever, is super
Just keep
relatable.
adding to it, just give them a mini fridge, maybe put in a separate sink, hopefully you have a separate entrance. That's really critical. It's not a requirement per law, but it's one of those preponderance of all the facts and circumstances.
Nice. That's great. I was just looking through our chat, and I think we've answered the ones that have come through in the chat. We have about 10-ish more minutes here. So if anyone has any other questions, feel free to throw them in the chat. Also, if you want to raise your hand and come off mute, I'm happy to take your questions that way as well.
On Rob's question, hey Rob, if you're okay, would you want to just expand on the question about and you write, and if they've already been operating for, let's say, 2+ years, and now coming to a PM, they don't qualify, correct? Do you mind adding some context to that? Maybe Rob can't talk either. Maybe he's in a meeting.
I had a quick question. Oh, he's having mic issues. Well, until he fixes that, what app do you recommend for them to track expenses and that kind of stuff on that you mentioned earlier?
Yeah. Well, before I overspeak, CJ, does Evolve have a referral for this?
Not specifically, not on the tracking of
Okay.
expenses. Yeah.
Yeah, WCG, we have partnered with a company called Reps Log, and Reps is a bit of a misnomer. It's real estate professional status. It works the same way. So their app, Reps Log, and I can throw in a link on that too. Their app is basically just to help you track time and to track those receipts and track and track mileage. And I'll just put that into chat. If you just type rep log into your favorite search bar, you'll get it.
So
I think also, and go ahead.
My question was, let's say we're talking to a person who's already had I think you already answered this question, but that they're specifically have been self-managing now for the last 3, 4, 5 years. They've never written off this depreciation. They're just the second home and not really aware of those kind of things work. Can we still do what you said, where they're able to have those write-offs for depreciation and have them refile for those previous years or for the next year? How does that work?
Yeah, and we're not going to refile, like in my example where you didn't take advantage of the depreciation that was available to you. We're not refiling those tax. We're not amending those tax returns. That is an option. We don't like it. No one likes it, right? So that's where that 3115 change in accounting method and all that stuff comes into the play. It prevents the arduous task of amending tax returns. So, Rob, in your example, you've been managing this yourself for a couple of years, and then you turn it over to Evolve to help you manage it. Is that the setup?
Yeah, exactly.
And your concern is, I turn it over to Evolve to help me manage it, and in that same year, I'm going back and doing a cost segregation study and taking that depreciation that I didn't take originally.
Yeah, that's an option for them, and that will help direct them in that direction, Yeah,
100% available. Yep. And this is where our rental expert team comes in to play, because it's very nuanced. If that was a long-term rental for, let's say, 2 years, and then you convert it to a short-term, and then you say, hey, I want to do a retro cost segregation study and go back to the time that it was first a rental. Mm-hmm. You can do that. What you cannot do is take depreciation or take bonus depreciation, even though you're eligible in the current year. The years that you're doing the look back cost segregation study on were not eligible years under the short-term rental loophole. You can still make those if you're a real estate professional as defined by the IRS, or if you have other passive income to offset. So it's a chicken or egg at times. If you have a short-term, and then convert to long-term, and then do that look back cost segregation study, you are okay, because during the years in question, it was a short-term, but the reverse is not true. So there's some timing with this. So, and what a short-term rental, so maybe I should just back up. When you have a rental loss, it is going to be limited potentially by passive activity loss limits. Real quick, if you have over $150,000 of adjusted gross income, you cannot deduct your passive activity losses. They're suspended to the future. How to get around that is either short-term rental loophole or real estate professional status. And that's usually when you have multiple long-term rentals and that's all you do, right? Um, so does a short-term rental in year 2, 3, 4 give you a tax advantage? Yes, because you might still have losses being thrown off with depreciation or caused by depreciation, and you're still able to deduct those because you're getting around the passive activity loss limits because it's a short-term rental that
So
you
not
also participate in.
Okay, perfect. And then not to monopolize the conversation, but just a quick follow-up.
Sure.
So like CJ was saying too, where there was a lot of misinformation about using a PM, is now if we had this conversation with a homeowner and they go ahead and do some of their own research or talk to their CPA, is that knowledge more common? Like information's out there and they won't kind of get those roadblocks to where you're kind of feeling like you lose credibility?
I mean, it's still a bit shocking, unfortunately, how many tax professionals don't know about this, or they know it and they put it on the wrong tax form, like a Schedule C as in Charlie, not E as in Echo, which is where it belongs. There's a lot of misinformation. People talk to their bartenders, right, and get misinformation. So, yeah, you're gonna have to fight that and say, "Ooh,
Is
I'm not sure you're getting the best advice. You might want to talk
is
to somebody else."
So that another quick then. So let's say they're trying to talk to a CPA or someone like that. Is there some signs they should look for, or certain phrases in their title or expertise that we should direct them towards? That way they can kind of know that they're speaking to someone. I mean, is there people that market themselves directly for this?
Well, I mean, we do. I mean, that's one of the things we do. But real quick to answer your question, are there identifying markers, if you will, in the conversation that is going to tell you that that they might be misinformed? I would just encourage you to look at the materials on our website, this slide deck, and just when you hear things that just just don't make sense or are contrarian to what we talked about today, maybe that's the clue. You know what I mean? It's really, I mean, I think you'll identify the markers pretty quick when you have these conversations,
Yeah, I
and
just
just
wanted to
say, hey,
know.
I'm not, yep. And sometimes you don't know all the facts, right, of what they got going on from a tax return perspective, but what we talked about today is pretty across the board. So
Nice. Dean, I know you've had your hand up patiently
yeah, Dean's been
waiting.
like this for like 5 minutes.
Oh, no,
So
it's
go
all good.
ahead.
It's all good. That's why we put this up. And it may be a conversation that we have to take offline, Jason, more
Sure.
exploratory. But I had 3 short-term rentals, sold one last year. I've had one now for 10 years, the other one for 4. Um, I'm in Washington State. We just bought our second home in Palm Springs. And I was worried about cash flowing that property. Then I'm thinking, backup plan might be to have to sell one of my rentals at some point. This opportunity might help me help cash flow that purchase and not have to sell it. And then down the road, I could then maybe then roll it in 1031 into, or the 729, whatever you talked about, 721 into a
Yeah.
REIT or something. So that way now I'm done managing it. I just roll off the cash flow. But am I kind of thinking along the same lines that, the right lines, that this might be a way to improve my cash flow to therefore fund this other purchase I just made?
100%. Yeah. I mean, in fact, I'm in like Palm Desert right now myself, Dean.
That's where
So,
my Palm Desert. I didn't know most people knew where that was, but that's where the
yeah,
property
yeah.
is. So,
Actually, Rancho Mirage, you want to get really super technical, but
okay.
anyway, yeah, I'm here right now actually. So,
Okay.
yeah, no, that's a common selling feature, if you will. The IRS will fund a third of your down payment, if
Hmm.
you will. So, yeah, it's a good strategy.
I may need to
And
ping
I
you
know a lot of.
on that.
Go ahead. I'm
Oh, I was
sorry.
just saying I may need to ping you on it just to brainstorm a little more detail.
Yeah, yeah, it'll certainly help you out.
Okay.
Travis?
That segues perfectly into my question. I know we're about at time. Um, but just following this conversation, where can we go to connect with you or CJ or other folks, other Jason, just around like, hey, I have a specific question. Like, how do we continue this conversation?
Yeah, my direct line and um, in my email address is in chat right now. And I think on the slide deck that is going to be made available by Emmy and Sarah, my contact information is in there as well. So I'll give everybody a 20-minute discovery meeting, but for people on this call, I'll talk to you all day long about your particular situation or general situations. 100%.
And that also segues to the wrap up here. I'm Sarah. I work with our real estate network at Evolve, and really, grateful for your time, Jason, grateful for the partnership that we have, and for the real estate professionals on the call. Almost half the content of half the people who showed up today were our internal teams who support our owners, and really wanting to just kind of plug that one of the reasons to refer to us is because we have this network. We have a partnership with Jason's company where people can get discounts for those initial consultations. So if you're interested in referring to us, there's a website for that. And if you want to learn more about joining our network and learning more about other offerings that we may have to educate you, hit us up. We'll be sharing out some more information about how to contact us. So thanks again for your time, everyone.